Hello, Market Insights watchers. Welcome to the special holiday week edition of Market Insights. Ian and I are here on this short week just to share some fodder with you and what we're watching in the market. So hello, Ian. How are you going? How are things going today? How are you?
I'm good. It's Thanksgiving week, of course, Amber. And before we get going, I just want to say how grateful I am that, everyone who is here, who has supported us, um, we like to talk about what we're grateful around Thanksgiving in my family. And I'm definitely grateful that I have the opportunity, to work like this and work with you and the rest of our team, uh, every single day of the year. So that's what I'm grateful for this year. How
I
about yourself, Amber?
I concur. I second that emotion. I'm very grateful and thankful for you, Ian, for our team, but most importantly, our subscribers, where we would not
Absolutely.
be anywhere without each of you watching us and hopefully just enjoying what we put out because we do and love what we do and we do it for you with all our hearts. So thank you for sticking with us. So
What's going on in the Lancaster household for Thanksgiving? You
for
cooking a
things,
turkey?
well, this year there will be no cooking. It will be a local restaurant, which
Oh, okay.
I had to make a reservation because restaurants really fill up over the holidays here. So that's what we're doing.
Yeah,
Hopefully,
nobody likes to cook anymore Thanksgiving, right? Same here. We're just ordering Whole Foods.
Whole Foods. That sounds good.
Um, are you having turkey now at the restaurant?
Yep, it actually
Right.
it's a whole Thanksgiving meal. So you get your turkey and your sides, and then they give us little to-go bag with little extras you can take home for later, like if I
Okay.
like as if you actually cook something. So I'm like,
Yeah, I mean, isn't it funny? Like nobody like eats turkey outside of Thanksgiving. I don't even think they sell turkeys at the supermarket outside of Thanksgiving.
oh,
It's really like the worst thing, by the way, right?
I
I
just
don't
had
know.
that for dinner last night, but it was
Oh no.
ground turkey. Anyway, so I guess it's just me, Ian, eating turkey. I don't know. It's
Yeah. All
so
right.
so we'll get started with our market roundup this week. So first of all, U.S. inflation slowed in October, everyone. The consumer price index year over year fell to 3.2% from 3.7% the prior month. October core inflation, which excludes food and energy costs, rose less than forecasts at 0.2%. And now, this latest data shows inflation has declined significantly from the 40-year high reached last year. Now, on this news, stocks traded higher on the inflation data as speculation increases. Fed policy tightening cycles may be coming to an end. Now, that optimistic view helped move $23.5 billion into global stock funds in the week through November 15th. This is the second biggest inflows of the year, according to EPFR global data. And I'll end with one word now creeping into the economic narrative, Ian. And that
Hmm.
word is deflation. Walmart CEO said last Thursday that he sees potential for deflation or falling prices in the coming months, which are a sign that the Fed's rate hikes are working. So what do you think? What's your take on that, Ian?
Well, deflation is good in some things, but not all,
Mm-hmm.
right? Deflation is good in food prices and energy prices because it allows people to save more money
Yeah.
and spend it elsewhere. Deflation is not good in things like housing prices, right? So we don't want like total deflation. That was the risk
Mm-hmm.
after 2008 was that you would have this deflationary wave where assets, especially financial assets that people own, started going down, and there was the belief that, or there would have been the belief that the prices kept going down, which is why the Fed stepped in and really stabilized the price of assets in 2008 to stop, what could have been a much worse financial crisis into a Great Depression. I think, we've actually seen, because you mentioned the CPI X food and energy.
Mm-hmm.
You throw those in, you've seen a decrease in the price of food. I've seen some things talking about how like egg prices are down 20 or 30%. So is milk. Chicken is down. significantly from the high last summer. You're also seeing a sell-off in oil. The price of gasoline has come down pretty significantly in some places.
Right.
You know, I know people are going to say, I'm still going to the pump and spending $5 a gallon on gasoline. But, you know, I've heard reports that there's areas, like a colleague of mine was in North Carolina recently, and the price of gas was down to $2.75 a gallon. So it's definitely coming down. You know, you don't want it coming down too fast, because then you start to worry about a hard recession. But I think so far what we're seeing in the data, where, you know, people are still getting jobs, not at the rate that they were earlier this year. Wages aren't increasing as fast as they were, so that is kind of tampering expectations on inflation. You know, the signs right now are that we're headed probably for a soft landing, where it's like maybe growth is going to slow down, but not go into recessionary territory. And then from an investment standpoint, a lot of the damage that was done in 2022 is behind us, and that sets us up for another pretty strong bull market. We get these kind of resets in the market. Usually happens every decade. It just so happened this time we had a reset in 2020, you know, with COVID, and then the market took off, went probably a little too fast for its britches with all the monetary stimulus that came into the market. And we had a reset in 2022. And I think that's kind of paving the way for another longer term bull market, especially with the idea that interest rates and inflation may have peaked. You know, so you're going to start to see stocks pick up on that, on the idea that, you know, if the economy is not going to go into recession and we're not going to have runaway inflation, then the stock market right now at 16 or 17 times earnings looks pretty well valued. One last thing, Amber, actually two last things.
Sure.
We talked about this a couple of weeks ago, where Bank of America Merrill Lynch survey said that the amount of positioning that people are in stocks was the lowest it's been since the depth of coronavirus in 2020. That's huge. That means that a lot of people are underinvested right now. And that's just not retail, that's also institutions. So I think what we've seen in the last couple of weeks with this sharp rally is people are realizing they don't want to miss out on this, right? You know, there was a lot of cash that went on the sidelines and might have gone into bonds that was a little worried that rates were going to blow through the roof, right? The 10-year at 5%, or we would have some major economic contraction. None of that is happening right now. So you're seeing a wave of capital come back into the markets. That's number one. And the second piece is that breadth right now is very narrow, which means that when you look at the markets, there are only a handful of stocks that have gone up a lot this year. The so-called FAMGA, you know, or whatever you want to call it, the whole cohort of, you know, Apple, Facebook, Amazon, they're always changing the acronym, right? Those stocks are up, you know, 90% this year on an average. Right. And that's what's been really leading the NASDAQ higher. A lot of the mid cap and small cap stocks has been lagging behind. And we've been saying they are going to play catch up at some point. You know, it's been taking a lot longer. But I do think that because you've seen what looks like a peak in interest rates, then the mid cap and the small caps are going to start to follow the large caps right now. And it happened exactly like this after 2008, right? When the market bottomed in March 2009, and all you heard for the next year and a half was that this rally is too narrow. This is not the bottom. It's, you know, only Apple and Amazon are rallying is what they said. And, you know, it led to a 10-year bull market. So, you know, this is basically how it starts. You have a wall of worry and people always criticizing that, you know, this is not the way it's supposed to happen. But that's, you know, more and more people will come off the sidelines and realize this is the way it does happen. So that's basically what we've been seeing in the markets.
Okay. Very well there, Ian.
History doesn't rhyme, but it tends to repeat itself, right?
It does tend to repeat itself. You live long enough, you see things again. And you're like,
yeah, oh. Yeah. I've been in the market a little too long. Anyway.
So in Megatrends this week, everyone, I'm going to follow up on a great question that we received from Mickey in response to my 2024 prediction article published Wednesday, November 15th, titled "One Sector to Profit Big from Gen Z's EV Surge." Now, in this article, I focused on potential rapid fire growth in EV sales volume, especially for potentially younger generations when the $7,500 federal tax credit becomes a point of sale discount that at the dealer that consumers can take advantage of, which means that in 2024, the government wants to make the tax credit available for car buyers at the point of sale. So Mickey wrote the following, Ian. I'm going to read through it because it's pretty cool comment and question. And Mickey just writes, Amber, when I bought my Model X in 2019, 2020, there was a time limit expiring the $7,000 tax credit of June 30th. My wife and I were looking one more time at the Tesla dealership in Raleigh, a warehouse, not a showroom, on that June 30th date. We decided to go for the purchase and trade in our Toyota Avalanche. We raced home to Pinehurst to pick up the car and drive back to Raleigh. It was a Sunday evening. We got back, had an estimate done by their recommended used car group. We did all the paperwork and closed on our Model X at 10:45 p.m., an hour and a half before the tax credit ran out. To the point of my story is to make sure your tax credit info is correct. The tax credit reduced dramatically if the purchase was made on July 1st that year. It was running out on the Tesla Model X. By the way, I bought the Model X and a short time later bought $10,000 of Tesla stock. Now I own a Model X and $190,000 of Tesla stock, 1,000% return and growing, Ian.
Oh,
So,
that's great.
Isn't that great? So Mickey, go ahead.
Yeah, no, go ahead.
Yep. So in all, Mickey just likes to know, is there time limits on the current tax credit incentive that we're seeing now, this transfer?
That's a great question. So of course, that in 2020 was before the Inflation Reduction Act, right? So all the new EV subsidies are the Inflation Reduction Act. And back then, they only gave a limited amount of subsidies to each automaker, right? So for Tesla, for instance, after they used something like 200,000 of them, or they sold 200,000 cars, then those subsidies went away and new buyers didn't get that tax credit. As far as I know, it seems like the government is even incentivizing the tax credits even more starting January 1st, because we talked about how instead of taking it as a credit, you'll get it as a point of sale. Now, why is this important? Well, there are some people that just don't qualify for the tax credit. So I think if you have household income, annual income over $300,000, or if you buy a car, I think over $90,000, something like that, you don't qualify for the tax credit. And then there's other stipulations in terms of vehicle has to be made in North America. A lot of the battery components have to be sourced in North America as well. So each automaker is different. You might want to check with the dealership. But one thing that I have been seeing, Amber, is that a lot of the automakers, if you go to their website, will say, you get the $7,500 tax credit, but must order by, let's say, November 30th, the end of the month, or December 31st, end of the year. I think they do this to incentivize you to buy the car sooner than later, right? And so, automakers, and we discussed this before the webinars, every month they come out with a new round of incentives. So if you're going to buy, let's say, a BMW or an Audi in November, if you don't get it by the end of November, December is going to have different incentives. So you might get different cashback allowances, different APRs on financing. The residuals on the leases might be different, so the payments are going to change. So that happens every month. But it's just interesting to me that it seems like they're acting as if that federal tax credit in some cases expires at the end of the month in order to drive people to get a vehicle sooner than later. But as far as we know, the government is actually extending it to point of sale, where it's like the dealership gives you a discount on the car immediately, and not, you're not required to go take the discount on your taxes, which a lot of people can't do for one reason or another.
Excellent point, Ian. Very well said. And just to add just one little caveat, I did research that the tax benefit, meaning the entire idea of the $7,500 tax credit for the Inflation Reduction Act, will run from the years 2023 through 2032 and be available to those who qualify. So I'll leave it with that.
That's great. And I would just also note, Amber, that the automakers, they know that this tax credit is available. So in a lot of cases, they've been raising the prices of EVs and also hybrids that are able to get that, which I think is one reason why you've seen a slowdown in EV sales. I mean, there's a number of reasons. Number one, the charging infrastructure is nowhere near where it should be if you're not buying a Tesla. But we're also seeing that a lot of automakers are now adopting the Tesla standard. So if you buy, let's say, a Nissan EV, you can now charge, or in 2024, you'll be able to charge at Tesla's infrastructure, which gets rid of a lot of range anxiety, but I think people that are thinking about taking like a 1,500-mile road trip, especially through some states that aren't as developed,
Right.
there's real concerns about where are you going to charge the car, or if you have to stay at a hotel overnight, are they going to have charging infrastructure so that you can be charged and ready to go in the morning? I think that's still a major concern, and something that I don't think we have built fast enough in this country. But it's coming. Like, there's definitely demand for it. And plus, like, I have a hybrid, and I just want to throw this out there. Like, I know Tesla superchargers and their charging stations seem to work really well. The non-Tesla charging stations, I would say half of the time they don't work. They don't work. It's terrible, but it's good that you'll be able to use the CCS chargers on Tesla going forward in 2024.
That would be a godsend. I agree with that one, Ian. Okay, so let's talk about cryptos and Crypto Corner. I think you're going to touch on maybe Avalanche and Apollo, JPMorgan this morning.
Huge news this week, Amber. I mean, let me think of a good way to explain this. So, in the financial world, there are conventional investments, stocks, cash, with our bonds in there. And then there are what are known as alternative assets, alternative investments. And these could be private equity deals, bank loans, investing in hedge funds. And these alternatives are only available to people who are, either high net worth, or let's say you're a pension fund in North Carolina, or a big insurance company, then you have access to these alternatives. What JPMorgan and Apollo Group are doing is they created basically a proof of concept where they're able to tokenize an alternative investment and create more liquidity for it. Okay, so think about, like, you go and invest in a hedge fund per se. To get your money back, you have to wait for the redemption period, and in some cases they might not give it all to you at once. There's a lot of administrative complexity that happens in hedge funds, where it's like you pay a 2% management fee, 20% incentive performance. But having a token that's programmed with all these different criteria can make that process a lot simpler. And also, having a token that's fractionalized, and let's say, real estate's a good example of this. Let's say, like, there was a group that wanted to buy a big building in New York, and the way they do it is they get some equity and go get a loan from a bank. Imagine if they were just able to fractionalize the whole thing, right? So instead of raising $1 billion through a bunch of loans with some equity in it, they just sold like $1 billion worth of tokens to investors, and anyone who bought into it had some stake in it, and there was liquidity where you could buy and sell a share in this building. Same thing with like buying a share in a private equity group by tokenizing it. And so what JPMorgan and Apollo have done is created a way using Avalanche, which is a layer 1 very similar to Ethereum, to tokenize these real world assets that aren't very liquid, and creating more liquidity for the financial markets. I think that this is the beginning of what we're going to see this decade, where all assets, all financial assets, all real world assets have some type of tokenized representation. And the reason for that is that they just become a lot easier to manage, right? We have to have all these custodial firms and banks that keep track of who owns what. With the blockchain, though, it's a decentralized database that is very easy to manage who owns what in that blockchain ecosystem. And Bob Greenfield, who was the ex-CEO of the NASDAQ, he said this back in 2018 when he first learned about tokenized technology, that basically all financial assets are going to be tokenized. And I think one driver of this is going to be AI. And the reason for this is, right now, there's a lot of friction in our financial system, right? Just like on the individual investor layer. So imagine this, like every individual has a Schwab trading account, maybe they have a financial advisor, they have a house, but like the way people buy and sell things in life, like let's say you go to the grocery store, you have to use cash, right? So if you wanted to liquidate like a portion of your stock portfolio to buy groceries, there's like a bunch of steps that are involved. And like, maybe it's not the right time for you to like liquidate the stock portfolio. Maybe it's not helping you raise your financial objectives. My belief is that there's going to be this just matrix of financial assets in the future, right? That all are fungible and tradable against one another. And the algorithm understands who you are, what your financial objectives are, your age, especially, how much capital you're going to need in a year and 5 years and 10 years. And like when you go buy something, it basically just carves out a piece of whatever it thinks that you should lighten up on in order to add something else to your life. And I just think that's the way it's going. And this is only applicable if everything is tokenized and can be traded against one another. So it's this huge financial matrix. And I think what JPMorgan has started is the beginning of this, where everything we own will be tokenized. Even your house will have some tokenization where, most people are 100% owners of their house, or if they have a mortgage, maybe they own 30% of the house. You could actually have a token that represents the loan on your house, where it's like you could sell that loan, just a piece of it off, to buy something else in a manner that's much more liquid than it is now, right? And so I think that's where the financial system is heading, because this is just going to better optimize outcomes and financial outcomes for people, where you can never go wrong in a financial system when you're adding more liquidity, right? When you're giving people an opportunity to actually have a more liquid asset that can be easier sold, it creates a more optimal financial system and gets rid of a lot of the kind of overhead and graft that happens, especially in the banking system. So, this is like one of those things that it almost feels like it's a small step for man, but a huge step for mankind. And I think this is just kind of like the direction we're heading with everything. And you've seen a lot of interest that's been happening in the crypto space just over the last week. A lot of it has been driven by banks that are figuring out ways that they can deploy blockchains into what they do and make them a part of the financial system. So, pretty exciting news, and I'm sure we'll bring some more information on it as it comes in the future.
Yes, definitely will. Thank you for sharing that information, Ian. Well, that's it for this week.
Oh, one more thing we want to talk about.
Yes.
Don't go yet. Okay. So we're going to include a link on this. It's really cool consumer gadget that came out last week called Humane. And basically, we talk about AI, like how are we going to use it? How are we going to adopt it? This company, which was founded by the guy who developed the iPhone, as well as he partnered with the woman who helped develop the iOS software. They created basically a wearable gadget that is like a wearable piece of AI. So it's kind of like Alexa in that it answers questions for you with higher levels of AI, but it also has senses on it. And, when you see this video, it's pretty mind blowing, and it'll give you a sense of like where the consumer product adoption is going with AI. The price target is pretty high. I think $700, and they charge like $30 or $40 a monthly subscription. But I really want one, Amber.
I think
I have to clear it with the decider first.
Okay, yes.
Maybe I'll get it for Christmas. Who knows?
Just put it in her ear.
I'll buy it for myself for Christmas.
Okay.
I'll buy it for her, and then I'll use it.
No, don't.
No, I won't. Okay, I won't do
it. Oh, Ian.
All right. So that's it. I want to wish everyone a happy Thanksgiving.
Yes.
Any questions, marketinsights@banyanhill.com. Amber, to you and your family, happy Thanksgiving.
Same to you, Ian. Have a wonderful time with your family and a safe holiday, everyone. Have a great time.
Safe holiday, especially if you're traveling. Take care.
Take care. Bye-bye.